Afternoon's program, the Paycheck Protection Program and Employee Retention Credit. Is your business fully utilizing these relief programs? My name is Greg Wank. I'm a partner at Anshin and the leader of our food and beverage practice. And I'm joined today by our PPP leaders, Anthony Bracco and David Beckman, who are also the leader and a director, respectively, in Anshin's litigation support and forensic evaluation group, and our ERC experts, Gevertzman and Molloy, who are also both tax partners in Anshin's architecture, engineering, and construction practice here at Anshin. In addition to this session, Anshin has put together a resource center at anshin.com where you can see the latest information about how many programs are available to help you and your businesses. We've even updated it as recently as today with the latest article on the new Restaurant Revitalization Grant Program. Today's webinar will be recorded, and you will receive the recording and the slides after the program. We have muted all attendees, but we welcome live questions. Many of you have already submitted questions in advance, but please use the question box in Zoom to submit questions, and we'll do our best to get through as many as we can. And if you encounter any issues throughout our presentation, please also notify us using the question function or email events@anshin.com, and we'll try to help. And with that, let's get started. I'll turn it over to David Beckman.
Actually, Anthony Bracco is going to take the next slide.
I'll start this off, and we're going to talk about the PPP loan first and second draw loans, applying for the loans. If we can go to the next slide. Just talking about the eligibility requirements. On a first draw loan, the maximum loan available is $10 million, and on a second draw loan, borrowers are capped at a $2 million loan. And for a corporate group of affiliated companies, the maximum is $20 million on a first draw loan, $4 million on a second draw loan across all of those companies within the corporate group. There's also limitations in terms of the maximum number of employees that a borrower may have, and this includes all affiliates, domestic and foreign affiliates, in determining this count. And on a first draw loan, it's 500 employees. And on a second draw loan, it was reduced down to 300 employees to get the second draw loans to smaller businesses. For the hotel, restaurant, and news organization businesses, the maximum employees of 500 or 300 is based on per location. If you fall within any of those industries, you have 500 or 300 employee maximum per location. For either a first or second draw loan, you must have been in operation on February 15, 2020. A difference for the second draw loan, which did not apply for the first draw loan, is that the borrower on a second draw loan must demonstrate a 25% or greater reduction in their gross receipts when you compare any quarter in 2020 to the same quarter in 2019. So you will be asked to provide documentation of that reduction in gross receipts when you apply for the loan, with certain exceptions for smaller loans where you may not have to provide the documentation up front. However, ultimately, when you apply for forgiveness, you will need to provide that documentation. The next slide, please. So the PPP loan application date has been extended to May 31st. As of April 18th, there is $44 billion in PPP funding available. There have been concerns that the funding will run out before the May 31st deadline. So if you have not applied, I certainly say to get those applications in as quickly as possible. In terms of Loan applications, we list here the loan application numbers. There's 2483 or 2483C for first draw loan or first draw loan for Schedule C filers. 2483SD is the second draw loans, and the SDC for second draw for Schedule C filers. So it's a different application process if you are a Schedule C filer. In terms of calculating the loan amount, it is based on your 2019 or 2020 annual payroll costs, which the rules will define. Wages that you include in payroll costs are subject to certain caps. Employees are capped at $20,833 per employee, which is effectively 2.5 months at an annualized $100,000. So you take 100,000 times 2.5 months divided by 12, and that's where we get the cap. Owners are capped at $20,833. They're subject to very specific limitations that Dave will discuss later on as it relates to owners. On a first draw loan, your loan amount is the lesser of 2.5 months of your average monthly payroll costs, plus any outstanding EIDL loan that you may look to roll into the PPP loan, or $10 million. On the second draw loan, it's 2.5 months of your average monthly payroll costs, however, or $2 million. However, for second draw loans, the rules allow any business in the hospitality industry with the NAICS code starting at 72 to use 3.5 months of average monthly payroll costs. And just to note, if you're using the same year that you use for PPP 1, you're using the same 2019 for PPP 2, and you're using the same lending institution, you unlikely should not have to resubmit all of your payroll information, since the lender already has that information. That's not to say that a lender may not ask you for it, but under the rules, you should not have to resubmit documentation. Next slide, please. The first and second draw loans both have a 1% per year interest rate on a non-compounding basis. Any loans that were drawn prior to June 5th, 2020 have a 2-year term, and any loans drawn after June 5th, 2020 have a 5-year term. Now, anyone who received that loan before June 5th can go to their bank and request a modification to a 5-year. However, that's something that the borrower has to request from the lender, and the lender has the option of agreeing to it or not. All of these loans are 100% guaranteed by the SBA. There's no collateral required, and no personal guarantees required. Interest and principal payments do not begin until 10 months after the end of your covered period, and Dave will also cover, what exactly is the covered period a little bit later. And actually, I'm going to turn it over to Dave right now, where he's going to start. He's going to walk you through applying for loan forgiveness under PPP loans.
Great. Thanks a lot, Anthony. Appreciate that. So before we go over the next 5 or 6 slides about PPP loan forgiveness, please understand that this is a lot of material condensed in just to a few short pages. There's a lot of information. This is an overview. Some of you probably are familiar with PPP loan forgiveness. You may have already filed it, or you're getting ready to. So if there are questions that you have, please ask them either during this webinar or contact us afterwards, and we'll try to help you out as best we can. So starting with the overview, and this overview applies to current folks looking to apply for their first loan forgiveness. And if they've taken a second draw loan, the same rules more or less should apply. We are not aware of any reason for the SBA, or not so much reason, but we don't think the SBA is going to change the rules so much. The rules as they stand now apply to both first and second draw loans. So when you apply for your forgiveness application, you're going to go to your lender's portal. We do suggest trying to log in. Hopefully all the portals are open at this point. We know they've been shut down in different parts of time over the past few months, but go in, check it out, go through the data, see if there's any sort of templates that might be helpful when gathering data if you haven't started to do so already. The loan forgiveness applications can be one of three forms. There's a 3508, an EZ, and an S. There are a bunch of different rules that, so basically for the 3508S, it's for 150,000 or less in your loan. EZ, you have to meet certain requirements, such as the 25% reduction that you did not reduce employees by more than 25% when you compare Q1 20 to the covered period, and two other categories that must be met in order to get the EZ form. Otherwise, you're going to be filing a 3508. You're going to likely end up in the same place. You just need to do more information, submit more information. The forgiveness calculation is based on eligible costs that are either paid during the covered period, or if incurred during the covered period, are paid by the next billing cycle. The calculation includes gathering or accumulating your payroll and non-payroll costs. If you're filing a 3508, you potentially could have a reduction based on your FTE calculation, which is your FTE reduction quotient, which is basically your covered period FTEs divided by your reference period FTEs. And there also is potentially an adjustment for any reduction greater than 25% for any employee making 100,000 or less in 2019. And that calculation compares covered period wages to Q1 20 wages, both annualized, or hourly rate of pay. Now, for some people who are not familiar with this, there is some relatively complex calculations that are entailed. We're not going to walk you through. It would just take too much time to show you and walk you through what those calculations are involved. Again, please reach out if you have any questions about those types of calculations. The covered period starts the date that you receive your loan and can go out anywhere from 8 to 24 weeks. It's the borrower's choice on how long you need it. It depends on, you want to make sure you have enough costs that might be adjusted downward for FTE reduction quotient so that you get full forgiveness, assuming you have enough costs through the 24 weeks. Not everyone will. Some borrowers may not have full costs, but you accumulate as much as you can. There are additional expenses that we'll get to in the next slide or so. And then lastly, for those who are trying to file with an alternative covered period that did exist a few months ago, based on the new law, it does not exist anymore. So just the covered period, 8 to 24 weeks. Next slide, please. So payroll costs. The definition of payroll costs applies to whether you're applying for a new loan, whether it's second draw or first draw loan if you haven't taken out a loan yet. And it also applies to loan forgiveness. These are costs that include salaries and wages, bonuses, severance, commissions, cash chips, and vacation pay. That whole group above, those first four bullets, are what goes to the salary cap. The next two bullets, the employer contribution for group health insurance and retirement plans, or employer state and local payroll taxes, are their own category of quote unquote payroll costs, but are not included in the caps that we talk about in a minute or so. Just keep in mind when you're talking about health insurance, it can not only includes health, it can also include dental, vision, life, and disability, and only include the employer portion, do not include the employee paid portion. When you get to the actual calculation of forgiveness, the covered period drives how much you can include in terms of wages. So if you do an 8-week covered period, you're going to be capped at 15,385. Up to a 24-week period, it's 46,154. This isn't a magical formula. It's fairly straightforward. It's basically every employee is capped at 100,000 times the number of weeks, whether it's 8, 12, 15, 24, then divide by 52 weeks. And that's how you get your cap for wages paid in terms of what you can include as forgivable against your loan. Owners have different caps. They start at 15,385 like employees, but they cap out at 20,833. So the reason why it's from 11 to 24 weeks, it's the same is once you hit 11 weeks, 11 divided by 52 is about 22,000. You're going to stop at 20,833, which was the original cap in the old law, and they maintained that. Payroll costs must comprise at least 60% of total costs when you file for forgiveness. Next slide, please. So we put together on this chart a reference tool for specific to owners. It gives you a sense of who an owner is, what the caps are, and what costs can be included. The top part of this section, the cash compensation caps, is specific to wages, whether it's S Corp or C Corp, or distributions / share of income for general partners and self-employed Schedule C filers. The second part down below, other payroll costs paid by borrower, are those certain other quote unquote payroll costs that can be either included or excluded depending on what type of entity it is. So let's just start with S Corp and C Corp. If the owner owns less than 5% of the shares, they are not considered an owner for purposes of PPP forgiveness. And that's important in terms of caps. So if you're below 5% for S or C Corp, you're still capped up to $46,154 for 24 weeks. If you own 5% or more for an S or C Corp owner, it's $20,833. The amount that's paid out as wages or distributions during the covered period, let's assume it's 24 weeks. You're not only looking at the cap of the $20,833, you also need to look at 2019 compensation. And whether it's a W-2 wage or as reported on a K-1, it's going to be limited to your 2019 comp of 2.5 months divided by 12. So anyone who earned 100,000 or more or reported more than 100,000 on their K-1, you should still meet the 20,833 cap. In terms of what can be included, and this goes to whether you're filing for the loan or filing for loan forgiveness. So employer, state, and local taxes, you would include for S and C Corp, but there's nothing to include for a general partner. Health insurance, you can include it for a C Corp owner. You can include it for an S Corp owner if they own less than 2% of the stock. If they own more than 2%, you cannot include health insurance. And retirement costs for S and C Corps, you can include those amounts, but be careful, they are capped also at 2.5/12 of the 2019 employer funded portion for owners that were made in 2019. And those last two items are not included for general partners or self-employed. Next slide, please. Non-payroll costs. So you're limited to 40% of the total costs that are filed for forgiveness for the application, but a number of companies will need these costs in order to get full forgiveness. So let's walk through them pretty quickly. So you can include rent, and any of these costs, there's a February 15, 20 starting date. If you started a lease after Feb 15 or started taking on utilities after February 15 of 20, you cannot include those costs. So keep that in mind for any entities that maybe opened up a new location after February 15th and 20. So rent is for real or personal property. If you pay it to a related party, there's special rules that say that related party must also have a mortgage with the building as collateral, and it's limited to the interest that you paid. If interest is in excess of the rent you paid for that same month, then you'll get full forgiveness for that cost. Mortgage interest is for real or personal property, excludes prepayments of interest. Utilities includes gas, electric, water, telephone, etc. And there are 4 new costs that were added as a result of the end of December 20 law that was passed. Covered worker protection expenditures, supplier costs, operation expenditures, and property damage costs. For worker protection, any costs paid for during the covered period that relate to gloves, sanitizer, safety related to COVID-19, you can include those costs. Supplier costs, there's not a lot of guidance on what a supply is, but assuming it meets the definition, and we can help walk you through what that might mean. If it was ordered before the covered period and paid for during the covered period, you can use that as a cost. Covered operations expenditures includes any costs incurred for software, cloud computing services that facilitate business ops. The actual definition is about 5 more rows long. So think of things for doing your accounting, doing your payroll, doing ordering, anything that helps you run the business, that's a software or cloud computing you can include if paid during the covered period. And the last item, property damage costs, if you incurred any costs related to public disturbances that happened in 20 and it's not covered by insurance, you can include those costs as well. Next slide, please. FTEs, we could probably create about 5 or 6 slides on what FTEs are and spend a half hour on this, but I probably have about a minute or 2 to cover what they are. If you're filing a form 3508, you need to calculate FTEs for both your covered period and one of 2 reference periods. If you're a seasonal employee, there's other periods as well. If you think you meet that, reach out to us. We can help you tell you what those dates are. They're not included on this slide. But it's either February 15th through June 30th, 19, or January 1 to February 29th, 20. And you're going to compare those two calculations. If the covered period is greater than the reference period FTEs for all employees, you're capped at 100%. You don't have to worry about reducing your costs. If covered period is below the reference period, let's say it's 90 FTEs in the covered period and 100 during the reference period, you'd have a 90% FTE quotient. You'd multiply that 90% times your total payroll and non-payroll costs that you're reporting, and hopefully that's still in excess of your loan. You'll get full forgiveness. If it's below that, then you might want to look and see if there are other costs that you can pick up and report. FTEs are based on 40 hours per week. So you look at what each employee was paid, and it's done by employee basis. Look at what they were paid over your covered period and your reference period, divide by the weeks during those periods, then divide by 40, round it to the nearest 10th. If it's 1 or greater, keep it at 1. If it's below 1, then round it to the nearest 10th. You add those up for each period separately and do that comparison. There's also a simplified method that lets you assign 1 FTE to a full-time employee, assuming they're full-time during the entire covered or reference period, and 0.5 for anyone below that. So part-time workers, or if someone's a full-time worker but started midway between your covered period, in the simplified method, they'd be at 0.5. Next slide, please. So we just have a couple of FAQs here that we've seen a bunch of times. Can I report more payroll and non-payroll costs than the actual PPP loan? So initially, when the rules first came out, it was not clear, can you report more costs than the actual loan itself? It's now abundantly clear you can. And if your FTE reduction quotient is below 100%, you'll need to in order to get full forgiveness on your application. And then next, can I report just payroll? In other words, just your wages on the PPP loan forgiveness application? Absolutely. If you have enough payroll during your covered period that is in excess of your actual loan, even after FTE reduction quotient that might be below 100%, you don't have to report more than payroll. Would you want to, or do you think you need to? Possibly. There could be ERC considerations. You may be just getting by, you may be $3 above the loan and you want to give yourself a cushion. In those situations, you'd want to report more costs than just payroll. But it's up to you. As long as your total costs are 60% or greater, it can be just payroll or payroll costs as opposed to non-payroll costs. Next slide, please. And now Joe's going to take over and talk about taxability as well as ERC issues.
Just before Joe picks up there, let's just a couple of quick questions on PPP before we transition. One, I think there's some confusion on the 10-month deferral. People receiving that as a deadline to apply for forgiveness. Can you just clarify?
No, I'll jump in here. That it's not a deadline to apply for forgiveness, and in fact, you may apply for loan forgiveness anytime up until the maturity of the loan. So if you have a 5-year term, you have up until the end of that 5 years until you make that final payment to apply for forgiveness. And if you did wait, though any payments that you previously made, if you were to receive full forgiveness, those payments with interest would be returned to you by the bank. The issue with the 10 months is that you will be required to start making payments 10 months after the end of the covered period. You have plenty of time to apply for the forgiveness.
And if you get forgiveness after that, they're going to give you back the payments you made, right?
That's right. They will refund all the payments that you've made because the bank will be reimbursed by the SBA.
And the other that keeps coming up here, which maybe is a little bit ahead of ourselves, is people concerned about leaving payroll costs over for ERC. They don't want to use the whole 24 weeks. Is there an advantage to just use exactly the number of weeks you need until you hit that 100% and then stop?
So we cover that in the next few slides. Okay. So we can either wait for the next slides. Okay. No, I'll share with it. No, I'll share it now. Even if you report more payroll than needed, so let's say you report $2 million in payroll and you have $1 million loan, you're not losing that $2 million in payroll versus ERC. It's when you look at it in comparison to if you're ready to file for ERC, you look at the PPP in terms of what dollars are necessary just to get full forgiveness. So you can report, you don't have to get it precise to the dollar. You can report more and not worry about losing it. But we'll go into that in more detail in a few slides.
Thank you. Okay, Joe.
Thank you. All right, so taxability of the PPP forgiveness. When the CARES Act first came out, it was clear that loan forgiveness was excluded from taxable income. And that was one of the major attractions of this PPP loan. It was pretty much free money. You could use it and you weren't going to pay tax on it, and it would help you get through the hard times. Then during the year, the IRS came back and said, all right, if it's not going to be taxable, if it's not going to be taxable income, well, then you shouldn't be able to get the deductions for the expenses, which either way, it's the same thing as calling it taxable income. If they're not going to give you they're not going to tax you on $1 million of income, but take away $1 million of expenses, it's the same tax effect. So everybody was up in the air throughout the year. Is it taxable? Is it not taxable? We didn't get final answer until late December with the Consolidated Appropriations Act, which clearly said Congress's intent was to make this not taxable. So for federal taxable purposes, it's you get the deduction and you don't have to pick it up as income. Now, state-wise, they follow, most states conform to the federal tax rules on this. New York, New Jersey, most of the states around here all agree. You just, before you file your state tax returns, you want to just look it up, because there's a few states like California, Arizona, New Hampshire, they keep changing a little bit. So you just want to make sure that you're recording it correctly at the state level. Next slide, please. So now we're going to talk about the employee retention credit. This credit was originally introduced during the CARES Act, with the CARES Act. But the trick was you weren't allowed to get it if you had a PPP loan. So everybody was focused on the PPP loan, so they didn't pay much attention to the employee retention credit. Later on the CAA, they changed the rules for the 2020 and extended it to 2021. The rules that changed for 2020 were you were allowed to get an employee retention credit if you had a PPP loan, but you couldn't double dip. And what that means is the amounts that you use for your loan forgiveness, you shouldn't be using for employee retention credit. You can't use the same wages for two different things, which we're going to get to later on. I know that's a big part of this presentation, but we will get on to that. So the employee retention credit itself is a payroll tax credit. So it's not an income tax. You're not going to file it with your corporate income tax returns or your partnership income tax returns. It's going to be on your payroll tax returns, on your quarterly 941. Okay, so that's where you're going to see the employee retention credit. Unfortunately, it is taxable. Unlike the PPP, that's why if you had a choice, the PPP is the first priority, because there is no taxable income when you do the PPP. When you do the ERC, you're still getting a significant benefit, but the refund or the credit that you receive is taxable income or non-deductible wages, whichever way you want to consider it. So the perfect thing is to maximize the PPP and the ERC, which we're going to try to get to. Next slide. So for 2020, to qualify for the credit, there were two things. You either experienced a full or partial government shutdown, or you had a 50% reduction of quarterly gross receipts compared to the same quarter of 2019. Now, if you satisfied one of those, what did you get? You get a 50% credit up to $10,000 qualified wages annually. So $5,000 per employee per $10,000. So if you got 50 employees qualified for $10,000, that's $250,000 more in your pocket. There is an employee test. For 2020, the employee test was 100 employees. If you have over 100 employees for this test, you only got the credit for the people you paid not to work. Teleworking doesn't count as not working. Teleworking is working from home. Not working is people that did not show up at the office, did not do anything, but you paid them anyway. Okay, something to consider there is if you had people and you didn't pay them full salary, but you furloughed them, the furlough counts. The health insurance counts as a qualified wage, and you can use that for the employee retention credit. Next slide, please. Now, 2021, this is where it really gets interesting. So to qualify for the credit, you get the same thing. You experience a full or partial government shutdown. But now, instead of a 50% reduction in gross receipts, it's a 20% reduction in gross receipts compared to the same quarter of 2019. You're still using the 2019 tax year. You're not going, just because you're in 21 doesn't mean you're going to the 2020 tax year. You're still going to that 2019 tax year, which most likely is higher than the 2020 tax year. So more people will qualify. And then the credit amount went from 50% on $10,000 to 70% on $10,000. And the bigger piece is that it's not annually anymore, it's per quarter. So you can get $7,000 per employee per quarter. So that's almost $28,000 a year per employee if you qualify for all 4 quarters. And the employee test, again, went from 100 to 500. So again, if there's more than 500 employees, you only get the credit for people that aren't working. Next slide, please. This is, so average employee calculation. This is sometimes a misconception. I ask this, everybody, all the clients that I start talking about the ERC, the first question I ask is, what is your average annual monthly employees, full-time employees in 2019? See, this test is different than the PPP. It's based on your 2019 average monthly employees, not your W-2s. Don't go by how many W-2s did you issue in 2019, because that doesn't mean that's as many average monthly employees you had. If somebody worked 1 week of a month, they're not qualified as a full-time average employee for that month. So you would take the, if you're nowhere near 100 or nowhere near the 500 test, you don't got to take the time. But if you're looking, if you issued maybe 520, 550 W-2s, and you're thinking, well, maybe I'm over the 500, take a look at your average monthly employees, because you probably are lower than that. And you would qualify, and all of your employees would be able to get the credit. Now, in 2019, if you were 100, and in 2021, in 2019, if you're 400, and in 2021, you're over 500, you still qualify for all your employees, even though you're over 500 employees now. It's the 2019 test that you got to worry about. Next slide, please. The gross receipts calculation. This is a common question that I see a lot. And what it comes down to is, what is the revenue you would show on a quarterly tax return, not financial statement? So if your financial statement is on accrual and your tax return is on cash, you would be using tax basis revenue. So gross receipts, it would be what is showing up on line 1 of your quarterly tax return. So you want to go with your accounting method that you use for your tax returns to calculate what your quarterly gross receipts are in 2019 and in 2020, or if you're doing 21 to 2019, those are the gross receipts or the gross revenue you want to focus on. Next slide, please. Qualified period and look back rule. This is good. If you qualify for one period, you automatically qualify for the next period. And the reason that is because the rules say that the taxpayer qualifies until the period after he fails the gross receipts test. So in the period after you don't have that 20% reduction, that's the period you're good till. So look at this example. So you got in quarter 1 of 2021, you have a 40% reduction. You're good for quarter 1. Once you know you have that 40%, you know you qualify for quarter 2. Now in this case, quarter 2, you have a 30% reduction. So you know you're going to qualify for the quarter 3. Now in quarter 3, you only have a 15% reduction. So you stop there. That doesn't mean you're not going to qualify for the fourth quarter. You could still qualify for the fourth quarter if you have a greater than 20% reduction in gross receipts, but you don't know that. The reason why it's beneficial to know that you're going to have a reduction, that you know you qualify for the next quarter, is because you don't, again, this credit is on your quarterly payroll tax return. So you don't file your quarterly payroll tax return until a month after the quarter. By the time you get that credit or get that refund, I don't know the time frame for when you're going to get that refund. What you can do, though, is when you know that you're going to qualify for the next quarter, you can reduce your payroll deposits. Okay, so you can increase your cash flow and reduce your payroll deposits, and you don't have to wait for the big refund at the end or whenever the IRS issues it. So it's a way to speed up the process of increasing your cash flow by reducing your deposits. So when you know you qualify, that's something you want to consider. Now, the look back provision to 2021, this is good because if you don't qualify for the fourth quarter of 2020 because you don't reach the 50% test, you might qualify for the first quarter of 2021 because you have a 20% reduction. So right now, if you're looking at your first quarter and you don't qualify, you don't have a 20% reduction, double check your fourth quarter 2021, fourth quarter 2020 compared to your fourth quarter 2019. And if you have a greater than 20%, you will qualify for the first quarter of 2021. So it's significant and it can help you put more cash but you don't know if you will qualify to the second quarter until you do that gross receipts test. Next slide, please. Now, Paul is going to talk about the aggregation rules.
Thanks, Joe. Thanks, Joe. So what happens when you have multiple companies involved? And this can come from a number of different circumstances. It can mean multiple businesses with the same or substantially the same owners. It can mean multiple subsidiaries, either filing as a consolidated group or not, but with separate payrolls. It could be from related foreign companies with the same or substantially the same owners. Under all of these scenarios, we need to determine if the companies need to be treated as an aggregated group for ERC purposes, because if they are, then they're treated as one employer. If they do need to be aggregated, all the eligibility measurements that Joe spoke about, we need to look at on a combined basis. And this means that we have to aggregate their 2019 average full-time number of employees to see if they're over or under the 100 or 500 thresholds that Joe mentioned. It also means we need to aggregate their quarterly gross receipts to determine if the revenue declines that Joe referred to compare to the same aggregated gross quarterly receipts in 2019, again, on a combined basis. And here's where it gets interesting, because when it comes to employee count, aggregating as a group can only hurt you, right? Adding your employees can push you from being classified as a small employer where everyone paid is qualified, whether working or not, to being a large employer where only those paid and not working are qualified. And that's a significant difference. When it comes to aggregation of gross receipts, it may hurt you, but it also may really help you to qualify. And that's because when the companies need to be aggregated as one employer, it becomes a one for all and all for one. Here we have a short example to illustrate what I mean. We have three companies, A, B, and C, all commonly owned. We'll assume that they have more than 50% common ownership, and we've concluded the three need to be aggregated and treated as one employer. By the way, in some cases, determining common ownership can be easy, but there are attribution rules that come into play here. So combining an individual's ownership with certain other family members, or if there are trusts involved, or either the grantor or the beneficiary. So don't assume if you don't have identical ownership over 50% that you can ignore the aggregation rules, right? You really have to look at it. But again, let's go back to our example. You have to look at this on a case-by-case basis. Here we are aggregating A, B, and C. And as you can see, A and C had gross receipt declines in the third quarter compared from 2019 of greater than 50%, but B did not. So if these companies did not need to be aggregated, A and C would qualify for the third quarter because they need to be aggregated as one employer. And as a group combined, the receipt decline was less than 50%. The entire group does not qualify for that quarter. As we said, one for all for one. However, if the numbers were changed slightly, right? Let's say C had 2020 gross receipts of 160, and now C would not qualify on its own. And let's say B was now down to 110 receipts in the third quarter. So B still doesn't qualify on its own. But now, because A had such a big drop, on a combined basis, the third quarter receipts are only 295, which is more than a 50% drop from 600,000. So now the entire group qualifies because of A's drop. So sometimes aggregating one for all for one can be a very good thing. And the last item under aggregation here relates to employers qualifying under the government shutdown order rules. Any period that the aggregated group qualifies based on a shutdown order, the entire aggregated group qualifies, even if some members were not actually shut down. And that's a good segue into the next slide, please. So government shutdown orders, this is the other way to qualify, right? It's either or. Somebody had a question on that. Even if you have failed the gross receipts decline tests, it also can include a partial shutdown to qualify. So if you have multiple businesses, as we discussed, or if you have multiple lines of businesses or multiple locations, some were subject to the shutdown orders, others were not, for the period that you qualify, the whole company can qualify. And recent IRS guidance has provided us with a number of relevant examples of what would be considered a partial shutdown, even if you were deemed an essential business and were not shut down. There are various circumstances under which you may have been impacted, and that would be considered a partial suspension. For example, if you had to reduce hours or had to close for a portion of the day to disinfect your facility, these types of nominal decreases that impacted either receipts and or the employee's ability to work could qualify as a partial shutdown. Throughout 2020, many different types of businesses experienced these types of shutdowns. Even in 2021, with social distancing orders, many businesses such as restaurants or concert halls or stadiums are still operating at limited capacity. If you're in New York or New Jersey and you were impacted in 2020 by some kind of shutdown, likely it started late in March before you got any of your PPP money. So again, there's no conflict there, and the partial shutdown can really help you. Really, I think the takeaway here has to be, if you fail the gross receipts drop, but you do feel you had some kind of business interruption, you got to investigate it. Reach out to our team to see if your interruption qualifies as a partial shutdown. There are a lot of great examples out there, especially if you're under the small average employment threshold and all your employees could qualify. For 2020, it doesn't take a lot of interruption to get $5,000 credit per employee. And if you have 90 employees, that would be $450,000 for 2020. And if you're experiencing a shutdown in 2021 where the benefits and the employment count jump, that potential benefit can be a very significant multiple of that number. Next slide, please. So starting with the bottom half of this slide first, there's guidance out there now. If you were not in existence for all of 2019, you can make the gross receipts comparisons to the closest available quarter. For example, here, if the business started in the second quarter of 2019, for both the first and second quarters of 2020, you would just compare receipts to the second quarter of 2019. And then for the third and fourth quarters, you would just use the normal third and fourth quarters from 2019 for comparison. If you started in the middle of a quarter in 2019, you would have to use a reasonable method to extrapolate what the receipts are estimated to be for that full quarter to compare. And on the top of this slide, there's now a new opportunity for a business that first came into existence after February 15th of 2020, and that cannot otherwise meet the qualifications to qualify for retention credits of up to $50,000. And it's for both the third and fourth quarters of 2021, so long as their average annual gross receipts are under $1 million. So for anyone just starting a business now, you can qualify even with no shutdown. And obviously, if you're just starting now, you had no drop in receipts. So for benefits for third and fourth quarter of 2021, this is very important for new businesses. Once again, obviously, aggregation rules may apply if you already have an existing business. So really, this is really meant for a true startup business. Next slide. Joe, you want to do this?
Yeah, okay. Form 7200 is available for people that don't want to wait for the employee retention, for the 941 to be filed, or want to apply for the credit earlier. You can file the Form 7200 to request advance payments of the employee retention credit. Now, you can do that while you're reducing your deposits. You don't want to double up and reduce your deposits and request the same credit, because then you're overstating your refund amount. But there are limits. So you do have to be a small employer. So you have to be under that 500 employee number, and you can't request more than 70% of the average quarterly wages paid by the employer in a calendar year 2019. So there are two limitations for the 7200 form, but it's consideration if you want to speed up the process of getting that refund. Next slide.
Before we jump into our frequently asked questions, Greg, are there other questions that you want to present?
Yeah,
to
thank
the,
you.
Audience?
Thank you, Anthony. Paul and Joe, there's a couple of repeating themes in the questions coming in on ERC. One is just clarifying for people. A lot of people think that ERC is something you have to apply for, like a PPP loan has to be applied for. Can you just walk them through, how this really works in practice?
Sure. So it's as of right. It's something that you do as part of your payroll tax filing. It's not an application. There's no need certification. If you qualify, you qualify, and it's done through your payroll filing, the normal 941 filing. And again, as Joe said, there's an advance form, the 7200, if you want to get it in advance of filing the 941. You can also amend your 941. Let's say for 2020, you now discover you're eligible based on the new rules. You really have 3 years to amend, which is a reason why obviously it pays in some cases if you can wait to get all the information and decide which is the best way to maximize. But there's no special approval process. You do it as part of your normal 941 filing. If you're using a PEO, obviously the PEO is going to be involved, but it's just part of your normal payroll filing.
Thank you. Also, a lot of questions in on the partial or complete shutdown as to the applicable period. So if a business was shut down for a few weeks, a couple of months, how long are they eligible for? Which quarters or whatever would they be eligible for ERC?
So only the wages in the period of the shutdown qualify. If there's a shutdown in the period, the whole quarter qualifies, but that doesn't matter. You don't care about the quarter. You care about the wages paid in the period of the shutdown.
Got it. Okay, so then even if you have affiliates that were not shut down, your wages that you paid on that one affiliate, as long as you meet the requirements overall as a combined group, you can still do that. Okay.
Yeah.
Yep.
Great. I think there's one other question around, well, we're going to get to that, I think, in the how the two interplay. That's what we're going to get to right now in these FAQs. So let's hold off on those types of questions until you get through these slides.
Okay, so we'll just go some of the frequently asked questions that we receive.
Go back a slide, please.
One back one. Yeah. So can I be eligible, Dave, for both PPP and ERC for 2020 or 2021?
Absolutely. Each program or the ERC applying for the credit, they stand alone. You just have to realize, and we'll get into this in a few minutes, that you can't use the same payroll for both programs, but we'll talk about that in a few minutes.
And are there any issues I need to consider if I take a PPP loan in 1 year and apply for the ERC in the following year?
Yeah, so there may be circumstances where you're eligible for, say, a PPP loan in 2020. You don't take a PPP loan in 21, but you are eligible for an ERC credit in 2021. There's no overlap. There's no concerns. They stand alone. You don't have to worry about offsets or payroll or anything of that nature. So you should be safe.
Okay. Next slide. And I think, so this will be, I think, for either Joe or Paul. Can I deduct expenses on my corporate return if I use these expenses for PPP loan forgiveness? And for ERC, is payroll deductible that that is used for the ERC?
The answer, yes. For PPP, you can deduct the expenses on your corporate return. For ERC, again, if you have $10,000 qualified wages and in 2021 you're getting a $7,000 credit, you get the net benefit of $3,000. You don't lose the $10,000 deduction, you lose the $7,000 deduction, or you recognize $7,000 of income, however you want to show that.
Okay, and if I've already filed a loan forgiveness application for a PPP loan that I received in 2020, can I use the same payroll that I use as a payroll cost on my loan forgiveness application for my 2020 ERC?
Absolutely not. Again, that goes to the no double dipping. You can't use the same wages twice. And once you kind of elect to put it on your ERC, you're kind of electing out of forgiveness. But again, we're going to get into PPP, how if you put it on your PPP forgiveness application, it might still be available for your ERC.
Right. Okay. Next slide. Okay, so if I've not yet filed for PPP loan forgiveness or for the 2020 ERC, Dave, which program should I apply for first?
Well, Anthony, as I think Joe mentioned earlier, PPP is beneficial because you get the benefit of not having any taxable events occur by getting full forgiveness or the costs used for deductibility. So typically, but maybe not always, you're going to look at PPP first and then ERC second. But I do want to caution, if you haven't filed either yet, you should look at it, schedule out by employee, the payrolls used, and do a relatively complex analysis of what is going to be applied where, because there may be advantages for whatever reason to apply it in a certain fashion so that you get the maximum benefit for both programs.
All right, and I think that leads to the next question. If I know I'm eligible for the ERC in 2020, when I'm filing my PPP loan forgiveness for my first draw loan for 2020, should I report all of my non-payroll costs so that I reduce the amount of payroll needed for full PPP forgiveness so that I have more payroll available for the ERC?
Sure. So the knee-jerk reaction is yes, report as much non-payroll costs as possible. You don't want to worry about losing any of the payroll costs that you're going to use for PPP that you can't then use for ERC because you've used it already. But and there's 8 or 9 different buckets of costs that you need, and you can spend a lot of time trying to dig up every last penny to try to maximize your PPP and ERC. Do you need to do that? Not necessarily. And in most cases, no. In fact, there are going to be some companies where their payroll is so significant over the covered period, and if they're eligible for all Q2, Q3, and Q4 of 2020, they only have to report payroll because there'll be enough dollars for both payroll PPP forgiveness as well as full eligibility on an employee basis for ERC. So really, it depends on the circumstance of the borrower.
Okay. Next slide, please. So if I've already filed for the ERC for 2020, what should I consider when I'm filing for my first draw PPP loan forgiveness?
I mean, the key point here is whatever dollars have already been dedicated and used for ERC, you can also use for PPP. So you're basically going to look at your covered period. That's not going to change regardless of whatever you do for ERC, you're going to have the same covered period. And you're just going to look, you're going to line up your employees, see what dollars were already used for ERC. You can't use those for PPP. Hopefully you'll still have enough dollars to get full forgiveness regardless of what was used for ERC.
Okay. Next slide. Here's a question that we do hear often. If I've already filed my PPP loan forgiveness application for my first draw loan and I've reported payroll costs in excess of my loan, do I lose the ability to use those excess payroll costs for the ERC?
So yeah, you don't lose it. And I know we talked about this earlier. Just want to hit home because this is an important concept for anyone who's concerned. You don't lose that extra dollar. So in this case, we have, for example, we have $1.2 million of payroll costs reported on the loan forgiveness, and we had $1 million loan. So do you lose that $200,000? You don't lose the $200,000. You can still use that for ERC. And it's not just a blanket, throw $200,000 up on a 941 and get a credit. So you got to do it employee by employee. Look to accumulate for 2020. It's in total $10,000 per employee. And if you don't have enough dollars during the covered period, you can also, in this example, look before May 1st. You can look at April 1, start of the second quarter, up to April 30. And you can also look after October 15th. October 15th is the end of your covered period. So you can look October 15 to the end of the year if you still need wages on an employee by employee basis to max out your ERC.
Okay.
Thanks. Next slide, please.
Next slide. So now if I've filed my PPP first draw loan application and reported payroll costs, loan forgiveness application, and reported payroll costs and non-payroll costs that are in excess of my loan, how do I determine the payroll costs that can be used for ERC in this example?
Sure. And I just want to say, I know we have about 5 minutes left in the webinar, and I know Greg probably has a couple more questions that he wants to ask. So we may go a little bit over. If you want to, stick with us for a few minutes, please do so. If you have to run, that's fine too. But I just, so in this scenario, we have $900,000 of payroll costs reported for PPP loan forgiveness and $600,000 for non-payroll. We only have $1 million loan. So you can look first to the non-payroll costs up to 40%, which follows the PPP rules. So we can go up to 400,000. So the first 400,000 is non-payroll. Subtract that from $1 million, you get 600,000. You would then, of the 900,000 reported, you only have to use 600,000 for payroll costs. So you still have $300,000 in total to apply to ERC. You still need to go and look on an employee by employee basis. Again, it's for 2020, it's up to 10,000 for the full year. And in this example as well, you can look before May 1st and after October 15 to make sure you maximize your total ERC credit on an employee by employee basis.
Great. And I think on the next slide, you've got another example that you wanted to talk about.
So this sort of scary looking carved out from an Excel spreadsheet. We're not going to go item by item, but the main point here is that there's an analysis required on an employee by employee basis. So in this example, the PPP loan was 70,000. Total reported on the forgiveness app was 121, leaving 51,154 for ERC possibility. And as you look, you'll see at the very last column on the right, each employee is maxed out for the ERC up to $10,000, except for one, because Alex Hamilton was only paid $8,000 during the Q2 and Q3 period. So we can't hit the 10 if they only were paid 8. So they're maxed out at 8. But everyone else is maxed out at 10. When you total that up, you're at $48,000. So you still have another $3,000 left over from the PPP loan forgiveness. The point here is, if you have 100 employees, there'll be a little more complexity to this analysis and looking at what was used specifically for the PPP loan versus what's left over and can be used for ERC.
Right. Okay.
Great, thank you, gentlemen. We have a website, as we mentioned, with these additional resources. Before we conclude, we are going to squeeze in a couple more questions because there are a lot of themes here that we keep getting asked about. Hope people inquiring about, they use PEOs who aren't too excited about amending prior 941s for them. Paul's nodding. I assume you've heard this already from some folks. What are companies supposed to do with that situation?
Right. So the concern, the problem is a PEO files in general as, they're filing it for a group. And, if I want to amend, they don't want to amend 7 different times. Right. So the feedback I'm getting is a lot of them haven't done it yet because they're kind of waiting. But you got to just keep after them, because the 7,200, you can file a 7,200, right? Obviously it's too late to do that for 2020. And your deadline for doing that for the first quarter of 2021 is April 30th. You can do that on your own, and then you just have to give the information to the PEO. But you can't amend your 941 if you're using a PEO. They've got to do it for you. So you just got to keep after them. Somebody who's not using a PEO, even if they're using a payroll provider, they can amend their own 941 if they have a problem with the payroll provider. But a PEO, you're kind of in subject to whatever they can help you with. You just got to keep after them.
Oh, Joe, you're muted. Joe, you're muted. We can't hear you.
I was saying, sorry. So that's one of the benefits of knowing that you qualify for the next quarter when you qualify for one quarter, because I'm seeing a lot of the PEOs are requesting you make the election to do the ERC well before the quarter is even ended. So they want to keep track of it, what you're doing. So you got to make an election pretty much the first month of the quarter, and they'll start keeping track. So that's a benefit of knowing you qualify.
Right. The other problem there is that if you not only are you waiting for your money, if you're waiting for the PEO to do an amended return, but it's also holding up filing your 2020 tax returns, because you need to know how much of a wage deduction you have to take.
And on ERC, are there any restrictions like there are with PPP on owner salaries or officer salaries? Are those also eligible?
So general rule is if you're over a 50% owner, and I got to be honest with you, there's no clear guidance on this, but it certainly appears that if you have over 50% ownership in a corporation, you're not eligible, right? Related parties, if you're related, right, to over 50% ownership, that's actually more clear that you would not be able to. So your spouse, if you're a 100% owner, your spouse would not be eligible. If you're in it with including all attribution, if you're under 50%, then you probably are eligible. On a partnership, partners don't get salaries, they get guaranteed payments. Guaranteed payments would not be eligible.
Okay. PPP2, David and Anthony, can we just clarify? A few people asked, they're confused about the 25% receipts test. Saying, well, I actually, my profit was higher in 20 than 19, but I did have a quarter where I was down 25%. Am I really eligible?
It's based on the gross, it's a gross receipts test and not your net profit. So you look at the gross receipts, and in fact, the original guidance indicated that you could really use an annual number. If you're down 25%, from year over year from 2020 to 2019, then you must have a decrease of 25% or greater in a particular quarter in order to have that annual decrease. But it's gross receipts. It's not on the net.
And back to ERC, if you were shut down or had a full or partial shutdown, but your workers were able to work remotely, so you really weren't impacted, so to speak, are you really eligible for ERC?
So there's actually something in the notice the IRS put out on this, whether, so technically if everybody was able to telework with no problems, then you haven't really been impacted and you haven't really experienced a shutdown. And they actually put in the examples, even if it took up to 2 weeks for everybody to sort of get acclimated and get everything up to running, if you weren't working remotely previously, that's not considered really impacted. If it's taking more than that, or if there are people who are not able to function at the same level, like let's say you have a pharmaceutical company and the lab people can't do the same work by teleworking, they have to do different work and it has an impact. So every situation is a little bit different. So you really got to look at every situation.
And last question, I think we'll squeeze in here, is on PPP forgiveness. Again, with timing, people are asking about how long it takes to get forgiveness. I think people might be interested to know that they're not alone, that many people are waiting for their forgiveness still.
Yeah, I mean, the rules as written may not exactly be followed by the SBA. You have 60 days by the bank to get through their process and then pass it on to the SBA. Then you have theoretically 90 days from the SBA to hear from them. However, in particular, for those borrowers with $2 million or greater who are also subject to filing Form 3509, the SBA is just taking longer. We don't know if it's because they're looking at the 3509 or if there's just too many for them to get through. There are definitely clients we've worked with who are over the 90-day limit at this point. So it's best we can say is be patient. I'm sure they're looking at it. It's a matter of time before you hear back. But we have heard for less than 2 million. We know folks have gotten approved as well.
Yeah, according to the SBA data, the forgiveness percentage is 99.9% pretty much. But that seems to be the applicants below 2 million. I think as of last week, there were close to 200,000 forgiveness applications, quote unquote, under review with the SBA. So, like you said, no real timeline. And also maybe interesting for people to know that out of more than 5 million PPP loans in 2020, more than 2 million still have not yet applied for forgiveness. So over 40% still haven't applied.
Greg, I think we're working on about 1 million of those.
So we're holding it up. Okay, sorry. We'll do our best. But thank you all. Thank you again for joining us today. Thank you to our presenters. We hope this was helpful. If you have additional questions and the questions we didn't get through, please email covid19@anshin.com. And we look forward to sharing and working with you more in the future. So thanks again.